Welcome to video 8 of part 2 of the EA Tax Training free EA exam prep course for 2025. Tom here, back with you to discuss specialized returns. This is the first of 2 videos covering topics that have not been covered in the rest of the course. In this first specialized returns video, we will cover rental real estate, farmers, and tax-exempt organizations. Our free resources from irs.gov. The slide is kind of busy because we got 3 different topics we're talking about here. So those in bold, the first 3 there you can see have to do with rental real estate. Then we've got 2 that have to do with farming. And then finally 3 in bold dealing with tax-exempt organizations. I definitely recommend those that are in bold. And if you want to look up the others to get more information, you are welcome to do that as well. Our first specialized return is for rental real estate. Individuals report rental real estate on Schedule E of Form 1040. If you own part interest in a rental property, then you report only your share of income and expenses. So if you own a rental property with your sister, for example, 50-50, then you report half of the income and expenses on your Schedule E, and she reports half of the income and expenses on her Schedule E. Rental activities are considered passive, so therefore the passive loss rules apply. Now you can see the exception there. They are not passive for someone who is considered a bona fide real estate professional, so we will talk about that. But for everyone else, rental activity is a passive activity, which of course means that any losses from a rental activity can only be used to offset passive income. They cannot be used to offset non-passive income, such as wages, etc. There is also a limited exception to that rule that we will talk about, but that is the general rule. If you provide substantial services, such as regular cleaning, changing linens, or housekeeping, then that is a business and it is reported on Schedule C rather than being a rental activity that is reported on Schedule E. And of course, if it is on Schedule C, it's a business, then that would be a non-passive activity as long as you are actively involved in the business. So what this is referring to, for instance, would be Airbnb. You've got a house and you rent it out through Airbnb or a similar type of program. Well, you're not just renting the real estate, you're also going to be cleaning in between and providing other services in addition to just renting the property. Maybe you're not doing it directly, you might be paying someone to do it, but the idea is you are running a business. So it's much like a hotel. A hotel is technically real estate that is being rented out. However, it's not treated as a rental property. It is a business that they are running. So the people are coming there, they're staying for the night, then they're getting house cleaning, etc., and so forth. And so the Airbnb is kind of on par with the hotels. And so that is why it is treated as a business. And that is not what we are going to be talking about in this video. We're going to be talking about true rental properties in this video. Let's have a look at the first page of Schedule E, where these rental activities are reported for individuals. So you can see here that you are going to list the properties A, B, and C. You're going to put their address. Then you're going to say the type of property for each of those, A, B, and C. You'll choose from this list. And then down here, the corresponding columns, A, B, and C, you're going to show the rents received as well as the expenses. Schedule E is also used for royalties, but for our purposes in this video, we are talking about the rents. So you show the rental income and then all of the various expenses. You'll remember from part 1 that the second page of Schedule E is where individuals report their income from partnerships, S corps, and trusts. So we're not going to look at that. It's not really relevant to rental real estate, but you can look the form over yourself to refresh your memory on that. Partnerships and S corps do not use Schedule E. Instead, they use this form 8825. And then rental activities, as you will remember, are not included in the page 1 ordinary business income on either the 1065 or the 1120S. Instead, they are separately stated on Schedule K and then on the K1. For a C corp, they don't use any kind of special form at all. On the 1120, line 6 is actually for rental income, and then all the expenses you would just show in the normal expenses of the corporation. But for the partnerships and the S Corps, this is the Form 8825, and it looks a lot like the Schedule E, except it has a place here on the first page for 4 properties, A, B, C, and D. And then you, again, have your rental income and then your expenses. And then page 2 actually gives you 4 more slots. So these are E, F, G, and H. So it is the same thing. If you have more than 8 rental properties, then you can just add more of these page 2s on in order to accommodate them. Reporting the income for rental real estate, income includes all rents received, including advance rent and lease cancellation fees. Security deposits, however, are not included in income when they are received because they have to be returned to the tenant as long as the tenant lives up to the term of the lease and doesn't damage the property or anything like that. So when you receive the security deposit from an accounting standpoint, that is actually a liability because you still owe that money to the tenant. So you would set it up on your balance sheet as a liability. So it doesn't count as income when it comes in. If you get to the end of the lease, everything is good, you're going to give that money back to the tenant, then you just reverse that liability and you pay them their money back. So when the security deposit comes in, it is not income. And when you give it back at the end of the lease, it is not an expense. However, if you get to the end of the lease and they did damage the property or violate the contract in some other way that allows you to keep that security deposit, then at that time, the security deposit does become income. So not income when received, only becomes income if you end up keeping the security deposit. Deductions for rental real estate, it would include all of these types of expenses. There could be others, but this is a pretty good representative list. Mortgage interest, not your whole mortgage payment, but the interest portion. Property taxes, maintenance and repairs, but not additions and improvements. We'll come back to that. Cleaning fees, utilities, insurance, advertising, depreciation, management company fees, etc. So let's talk about the maintenance and repairs. Remember when we talked about assets and depreciation, we had this distinction between maintenance and repairs and additions and improvements. So that is going to apply here as well. So as you'll remember, if you are putting in a new driveway, that is an addition. You can't deduct that. You add that to the basis of the property and then it can be depreciated. But if you are repairing a hole in the driveway, that's a maintenance and repair item. You can just go ahead and deduct that when you make that repair. Similarly, if you're putting on a whole new room, that's an addition. If you're just painting and repairing an existing room, that is a repair. Putting in a whole new air conditioner, that's an addition. Repairing the old air conditioner, that is repairs and maintenance, etc. So you will want to remember those distinctions. Depreciation for rental property. Residential buildings, you may recall, have a depreciable life of 27 and a half years. Commercial buildings have a depreciable life of 39 years. You will definitely want to remember those for the exam. Residential buildings, 27 and a half. Commercial buildings, 39 years. They are depreciated using the straight line method with the mid-month convention. Some items that are included in the purchase may be considered personal property rather than real property. Personal property can be depreciated over a shorter period of time, resulting in higher deductions in the early years of ownership. So, if you are buying, for instance, a furnished house, so not only are you getting the real estate, you're getting the furniture, the hangings on the walls, the appliances, etc., then you will want to separate out how much of the purchase price was for those personal property items from the real estate, because those personal property items you can depreciate over their recovery period rather than the, for instance, 27 and a half years that you would have for a residential house. Some buyers of commercial properties will actually hire engineers and other specialists to do a cost segregation study to break out the personal property from the real property. Because especially you get into some of these commercial buildings, it's hard for someone who's not an expert to be able to determine, is that personal property, or is that part of the building itself? So you have the experts go in, they do a study, and they say, here's how much of the property is personal property and what class that property would be in, or what recovery period it would be in, and how much of it is the real property itself. And so then similarly, you can deduct the personal property over a shorter recovery period. The $25,000 passive activity loss exception. As we said, rental real estate is considered a passive activity unless you are a bona fide real estate professional. So, what that means is that passive activity losses generally cannot be used to offset non passive income, such as from wages, interest, dividends, etc. But there is an exception for rental real estate if you actively participate in the activity. Active participation means you own at least 10% of the rental property and make management decisions in a significant and bona fide sense, such as approving tenants, rental terms, and expenditures. So, this is designed for your average middle class person or middle class family that owns a rental property or two. They are obviously actively involved. It is their property, and they just have this on the side in order to make some extra money. That's who this is aimed at. So if you actively participate in the rental activity, you can use up to $25,000 of rental losses to offset non passive income. Now, if you're married filing separately and you live apart from your spouse all year, then it's only $12,500. But for everybody else, $25,000 to offset your non passive income. Now, there is an AGI limit. So this allowance is phased out for those with higher incomes. So the $25,000 allowance is reduced by 50% of the amount that your modified adjusted gross income is more than $100,000 or $50,000 if you are married filing separately. So if your modified adjusted gross income, for example, is $110,000, then instead of a $25,000 loss, you'd be able to deduct a $20,000 loss from the rental real estate against your non-passive income. And obviously, if your modified AGI was $150,000 or more, then you would not be able to take any of the loss against your non passive income. In any case, any excess passive losses do carry over to the next year. So once you take your $25,000, if you've got more, that can carry over to the next year. If you're not allowed to take the $25,000, then those passive losses will carry over to the next year. So maybe next year there's a profit from the rental property. You could use the losses to offset that. Or if you do qualify for the $25,000, the loss carries forward to next year and you get another $25,000 next year. So you may be able to use it then. Bona fide real estate professional. So a qualified real estate professional does not treat rental real estate as a passive activity, and thus they can use the losses in full to offset their non passive income. So, in other words, they're saying if real estate is your profession, then that is not passive. It's your job. You're working at it, it is active. So, they will allow you to deduct the losses against your non passive income. In order to qualify, you have to meet both of these requirements. More than half of the personal services that you performed in all your trades and businesses during the year were performed in real property trades or businesses in which you materially participated, and you performed more than 750 hours of services during the tax year in real property trades or businesses in which you materially participated. You cannot count services you performed as an employee, even if they were in real property trades or businesses, unless you owned 5% or more of the business. So, for example, let's say you are a property manager and you are employed by a property management company. You don't own any of the company, you are just an employee. That's what you do, it's your full time job. Those hours would not count towards you being a bona fide real estate professional since you were an employee and not an owner of the business. On the other hand, let's say you own more than 5%, of a property management company and you do property management. That's what you do as your profession. In that case, those hours would count. So let's say you're a full-time property manager, you own 5% or more of the property management company, and then on the side, you've got a rental house. Well, even the loss from that rental house, you can take against your non-passive income because you meet the requirements for being a bona fide real estate professional. Renting out part of a property. So if you rent out part of a property, such as you've got a duplex or a basement apartment in your home, you have to divide the expenses that affect the whole house between those that are personal and those that are rental. So that would include things like mortgage interest, utilities, real estate taxes, painting the outside of the house, etc. Obviously, if you repair something specifically in the rental portion of the home, then that expense you could deduct in full. The ones you have to divide are the ones that affect the whole house. So let's say you have a duplex, you live in half, and you rent out the other half. They're exactly the same size. Well, then 50% of all of these expenses that affect the whole home, you would be able to deduct as rental expenses. If you, for instance, had that basement apartment, then you probably would want to look at your total square footage and say, for example, the basement apartment represents 1/3 of the total square footage of the house. Therefore, you could deduct 1/3 of all these expenses that include the whole home. If things like utilities are separated, like you've got a separate electric meter or water meter, and you as the landlord pay both of the bills. So you've got your duplex and you've got a meter on one side and a meter on the other. Well, if you as the landlord pay both of those, then you can just deduct the one for the rental unit because it's separated and you know how much it is. But if it's just one meter, one bill, then you would divide it just as we have discussed here. So you're going to divide it based on total square footage or number of rooms or whatever makes sense. The IRS will basically let you use whatever method makes sense and fairly represents the amount of rental property versus the amount of personal property. Renting your home, whether we're talking about a main or a vacation home. So there are special rules if you are renting your home. If you rent out a property for part of the year and you use it for personal use for part of the year, such as a vacation home, then you must divide the expenses between rental use and personal use. So obviously, you cannot deduct those that are for personal use. So you have to divide them. How do you know if something is considered a quote unquote home? Well, it's if you meet this test. It will be considered a home if you use it for personal purposes for a number of days that is more than the greater of 14 days or 10% of the total days you rent it to others at a fair rental price. So if this is your main home that you live in, then obviously it is easy. But the problems usually come in when we're talking about a vacation home. So let's say you've got this vacation home at the beach and you rent it out for 100 days during the year and you use it personally for 18 days. In that case, it is a home because you're looking at the greater of these two things. And 10% of the total days that you rented it 100 days. So 10% is only 10 days. So you're looking at 14 days as your test because that's the greater of the two. You use it personally for 18 days. Therefore, it is a home. And then you have to divide those expenses between personal and rental. On the other hand, if you rent it out for 200 days during the year and you use it personally for 18 days, well, in that case, it's the greater of 10% or 14 days. 10% of 200 days is 20. You only used it for 18 days. That means it does not count as a home. You do not have to divide the expenses between rental and personal. You can deduct all of those expenses as a rental property. Personal use. When we say days of personal use, what does that mean? It includes use by you or any other owner of the home. So if you and your sister own a rental home and you stay there 7 days during the year and she stays there 14 days during the year, then you have to count that as 21 days of personal use or use by a member of your family or a family member of another owner. So again, if it's a member of your family, a member of your sister's family, you have to count those days as personal days. There is this exception though, unless the family member uses it as their main home and pays fair rent. So if they live there all the time, this is their main home, and you've got a lease with them, just like you'd have a lease with anybody else who is not related to you, then those don't count as personal days. You can just treat that all as a regular rental property and deduct all of the expenses. Then personal use also includes use by anyone who, under an agreement, lets you use some other home. So you've probably heard of these services where you can swap houses. So maybe you've got a house on the beach and somebody else has got a house in the mountains in Switzerland and they want to come to the beach in the United States and you want to go to the mountains in Switzerland. So you agree, okay, for 3 weeks, we'll swap. Well, in that case, you have to treat those 3 weeks that those people stayed there as personal use days. And then finally, use by anyone at less than fair rental price. So you may have been to one of these auctions at a school or a church or something like that, and they have different things that you can bid on. And sometimes some of the people from the community will donate to the school or whatever as a charity item use of their rental property. So they might say, okay, you can use our beach house for 2 weeks. And then people bid on that. So let's say somebody bids and they agree to pay $2,000 to use that house for 2 weeks. So they give the $2,000 to the charity. The owner of the house receives nothing. Those people go and they stay in the house. Those days count as personal use days. Or let's say you let friends stay at your house for free. Or you just say, we have to pay to get the place clean. So just reimburse us for the cleaning costs and we'll let you stay there. Well, they're staying there obviously at less than fair rental price. So any of those days would also count as personal days. There is this exception, though, for personal use. Any days you spend working substantially full time, repairing or maintaining, but not making additions or improvements to the home are not considered personal use, even if your family is staying there. So if you need to go down to Florida to do some repairs on the beach house, you can go ahead and bring your family, and maybe they're out at the beach all day and you're back at the house making repairs. Well, that does not count as personal use days. But again, we have this distinction between making repairs and making additions. If you are adding on a new room, then those would count as personal use days. So that's one more example of where you need to know the difference between repairs and improvements. So once you know your number of personal use days and your number of rental days, how do you separate out the expenses for personal and rental use? The deductible rental expenses are the total expenses multiplied by this fraction, the total number of days rented at a fair rental price, divided by the total combined number of rental and personal use days. So let's say you rent it out for 100 days and you stay personally at the house for 20 days. You would take your total expenses for the house and multiply by 100 divided by 120. And any day that the unit is available for rent but not actually rented is not a day of rental use. So you don't get to say, well, I tried to rent it the other 245 days, or I guess 246 days because 2024 was a leap year. But I tried to rent it for those other days, so that should count as a rental day. No, it doesn't work that way. You only can use the days it was actually rented. So let's look at an example. Loretta lives in New Jersey and owns a vacation home in Florida. She stays in the home for 30 days during the year and rents it to others at a fair rental price for 90 days, earning $27,000 in gross rental income. The house sits vacant the rest of the year. Loretta has $16,000 of total expenses for the home for the year. So she can deduct 75%. 90, number of days she rented it out, divided by 120, which is the 90 days she rented it plus the 30 days of personal use. So she can deduct $12,000 of the $16,000 of total expenses. So then she reports $15,000 of net rental income on Schedule E. So it's the $27,000 of gross income minus the $12,000 of deductible expenses, leaves her with that $15,000. It should be noted that if you are renting your home as opposed to other types of real estate, it is not a passive activity. So renting your home, not a passive activity. But if the rental expenses exceed your rental income, you still cannot deduct that loss against your other income. However, you can carry the loss forward to future years as a rental expense for that year. So, what this is really getting at is you cannot use that $25,000 passive activity loss exception that we talked about if you are renting out your home, because it is not considered a passive activity. Therefore, the passive activity loss exception does not apply. But you don't lose those expenses. It's just that they carry forward to next year as a rental expense. And then for any real estate, whether it's your home or not, if you are not renting with the intention to make a profit, then you can only deduct your losses up to the amount of your income and you cannot carry any losses forward. So let's say you've got that vacation home on the beach and you do not actively try to rent it out. But sometimes you've got a friend or a friend of a friend who says, "Hey, can I stay in your home? I'll be happy to pay you." And so you say, okay, and you let them stay there, and then you accept whatever they decide to pay you. You're not really trying to make a profit. You just happen to get some rental income. So if that happens, you can deduct your expenses up to the amount of that income, but you can't deduct any more and you cannot carry those forward to a future year. Now, if you do just end up with a net profit from that, you would still have to report the profit. Although if you were really only doing it every once in a while, it's likely that your expenses are going to be large enough that that would not be a problem. And then finally, we get to the somewhat famous Augusta rule, or the 14-day rule. If you rent out your main home or vacation home for 14 days or fewer, you do not have to recognize the income and you cannot deduct any losses. So why is this called the Augusta rule? Well, every year there is that big golf tournament in Augusta, Georgia. And historically, there have not been enough hotel rooms in Augusta for all the people who come in for this golf tournament. So the residents there are able to rent out their houses for pretty substantial amounts for the week or 10 days of the golf tournament. And somehow they were able to go to their congressmen and senators and say, hey, look, we're just renting this out for a week or 10 days. It's really a pain to have to keep track of this and keep track of all the expenses, and then we have to report it on our taxes. We don't want to have to do that. Can't you just let us forget about it? And somehow they were able to get that passed. It went through Congress, and they said, yes, if you are renting out your home for 14 days or less, then you don't have to mess with it. You don't have to file it on your taxes. You don't have to report the income. You don't have to do any of that. Of course, you still can't deduct any expenses either, but this is kind of an oddity in the tax law. It is just totally tax-free income, and you don't have to be in Augusta, Georgia in order to take advantage of it. This applies to any home anywhere in the United States. If you rent it out for 14 days or less, you get the benefit of not having to report the income. Moving on now to our next specialized return, and that is for farmers. What we will look at specifically in this section is an overview of farming, then accounting methods for farmers, how income is reported, and then finally some special rules for tax computations for farmers. You are in the business of farming if you cultivate, operate, or manage a farm for profit, either as an owner or a tenant. So you will want to know that definition, and it has to be all of these things. You have to cultivate, operate, or manage a farm for profit. And you can either own the farm or you can rent. You can be a tenant of the farm. But this is not your vegetable garden that you have out back as a hobby. That does not make you a farmer. A farm does include livestock, dairy, poultry, fish, fruit, and truck farms. It also includes plantations, ranches, ranges, and orchards and groves. And a farming business is a business. And so most of the tax rules that are applicable to other businesses are also going to apply to farms. However, there are some differences, which is why we are highlighting it by talking about it in this video. A farm can be operated as a sole proprietorship, as a partnership, as a C corporation, or as an S corporation, just like any other business. It is the nature of the activity that makes it a farming business, not the type of entity. Sole proprietor farmers file on Schedule F of Form 1040 instead of Schedule C. So other businesses, as we talked about, for sole proprietors, they report on Schedule C. Farmers report on Schedule F. Partnerships also use Schedule F of Form 1040, and it flows to page 1 of the Form 1065 in the income section. C Corps and S Corps do not have a special form, so they're just going to report the revenue and expenses in their normal revenue and expenses. As we go through this video, for the most part, I am going to talk about the farmer as if they were a sole proprietor. Again, it just makes it easier to talk about and is more relevant to the types of question you are likely to get on the exam. But remember, the same rules and ideas would apply even if it is a partnership or a corporation of one sort or another. Let's have a look at that Schedule F. So you can see the basic information at the top, a lot like Schedule C. And then you're going to get down to the income. Now, this is a little bit different. You can see Part 1 here is farm income cash method. And then you've got Part 2 is farm expenses cash and accrual method. So we're going to see page 2 here in a minute. Page 2 has Part 3, and Part 3 is farm income accrual method. So we're going to talk about accounting methods coming up, but obviously they're going to have either cash or accrual. So if you're on the cash method, you report your income here on page 1 in Part 1. If you are on the accrual method, you are going to report your income portion on page 2 in Part 3. And then for the expenses, whether you are in cash or accrual, you will show them here in Part 2. And then you're going to come down to your net profit or loss. So let's look at that second page. Here's Part 3, farm income accrual method. And this is going to detail out all of your income on the accrual method. So now let's talk about those farming accounting methods. You can see right there on Schedule F, there is that big distinction between cash and accrual. And so, like any other business, farmers can use the standard accounting method. So they are going to choose between cash and accrual. They can have a combination or hybrid method, as other businesses do. And then there are special methods for certain items, and there are some that are just for farmers. And so we are going to talk about some of those. The first of those special methods is called the crop method, and farmers can use this with IRS approval. So this is for farmers who do not harvest and dispose of their crop in the same year that they plant it. So maybe they plant in the fall and they harvest in the spring, for example. Or maybe they plant in one year and it's a type of crop that needs to be in the ground for several years. So they are not planting and harvesting in the same year. What this crop method allows the farmer to do is to deduct the entire cost of producing the crop, including the expense of seed or young plants, in the year you realize the income from the crop. So it allows you to match the income with the expense. So you have the expense in one year. If you want to, under the crop method, you can hold off and not report those expenses until you realize the income in the future year. Next, let's talk about farm inventory. So farm inventory includes all products held for sale, purchased for resale, and supplies, such as For a hatchery, eggs in the process of incubation, all harvested and purchased farm products held for sale or for feed or seed, such as grain, hay, silage, concentrates, cotton, tobacco, etc. Supplies held for sale or that become part of items held for sale, so that's similar to other businesses. And then livestock held primarily for sale. Livestock that is held for other purposes, such as draft, breeding, or dairy, can either be depreciated as an asset or included in inventory. It is up to the farmer. So the farmer gets to decide for those livestock that are not held for sale, do I include them in inventory or do I count them as an asset and depreciate them? And then also, crops that are growing are usually not held in inventory. So if you got crops that are still in the ground at the end of the year, that does not count as inventory. Although there is this exception, if they have a reproductive period of more than 2 years, the costs may need to be included if the farmer is subject to UNICAP. So remember, UNICAP, though, you had to have that $30 million or more average sales. So your typical sole proprietor farmer is not going to have that, but of course it is possible on a corporate type of farm. But the general rule is crops that are in the ground are not considered inventory. Farmers that meet the gross receipts test, meaning their average annual gross receipts are under that $30 million number, are not required to account for inventories. That's like other businesses. So, like other businesses, they can instead treat those inventories as non-incidental supplies or use any method that conforms to their financial accounting treatment. But farmers who do account for inventory can use the same inventory method as other businesses, so FIFO, LIFO, average cost, as well as two special methods. So for the farming section of the EA exam, of course, we know that they can use LIFO, FIFO. We already talked about that in a different video. But what we want to focus on is the two special methods that farmers are allowed to use. They are called the farm price method and the unit livestock price method. These are not required, but they are allowed. First, the farm price method. Under this method, each item, whether raised or purchased, is valued at its market price less the direct costs of disposition. And the cost of disposition includes broker's commissions, freight, hauling to market, and other marketing costs. If you do choose to use this method, you must use it for your entire inventory, except for livestock, which can be inventoried under the unit livestock price method that we will talk about. But for all of your non-livestock, if you choose to use the farm price method, you have to use the farm price method for all of it. So what this is saying is instead of using cost, you are going to use the value of those items. So, what is the market value at the end of the year when you take your inventory minus the cost of disposition? That is the amount that you will include in inventory under the farm price method. Next is the unit livestock price method. This method recognizes the difficulty of establishing the exact costs of producing and raising each animal. So, under this method, you group or classify livestock according to type and age and use a standard unit price for each animal within the group. So, what you have here is when you are raising these various types of animals, it's hard to know exactly how much you spent on each animal. One animal maybe ate more than the other animal, so it took more feed. You have no way of really knowing that. One animal maybe needed more visits from the veterinarian than the other animal. So it can be very difficult to try to keep track of all of this. So what they're saying here is you can just group them together. So you can say, okay, we've got cattle, we've got horses, we've got chickens, we've got sheep, etc. You can come up with an average cost of producing and raising that animal. You may divide it into the young ones, into the adult ones, and you have these classifications. And then that price that you use should reasonably estimate the normal costs incurred in producing the animals in each class. If you do use this method, then you have to use it for all raised livestock in inventory. In other words, all the animals that were born there on the farm. You have to use it for all of them, regardless of whether they are held for sale or for draft breeding, sport, or dairy purposes. Now remember, those that are not being held for sale do not have to be held in inventory. But if you do use them in inventory, then you have to use the unit livestock price method for all of them. Depreciation of farm property. New machinery and equipment used in farming has a 5-year recovery period under makers. Used machinery and equipment has a 7-year recovery period. If you think about this, it kind of seems backwards. In accounting, we're used to thinking of useful lives, and we would normally think that a new machine or piece of equipment would have a longer useful life than a used machine or piece of equipment. But this is backwards. Here, the new machine has a shorter recovery period than the used machine. So remember, for maker's depreciation, we don't use useful life, we use recovery period, the number of years over which you can depreciate and deduct the cost of that asset. So, what Congress has decided is that new machines have a shorter recovery period than used machines. Likely that's because they are trying to encourage farmers to buy new equipment to help to spur the economy. But in any case, you do want to know for the exam this distinction, the 5 years versus the 7 years. And here is a chart of various assets in the farm. This comes right from publication 225, by the way, which was one of the publications that we saw at the beginning of the video. So you can see the different types of farm assets here. Let's zoom in to make it a little bit easier. We have both the general depreciation system and the alternative depreciation system, but we are going to be talking about GDS here. So you can look down and see the various types of assets. And you can see right here, new machinery and equipment, 5 years, used, 7 years. And you can see the other ones, goats and sheep are here, hogs, horses of various types, etc. Kind of interesting to see the years. You do not have to remember all of these. You might want to give some attention to these agricultural structures. These single purpose agricultural structures have a 10-year recovery period. And similarly, these single purpose horticultural structures have a recovery period of 10 years. Those are really real property, but they have only a 10-year recovery period. So that makes them kind of unique. And then other farm buildings you can see are 20 years. So remember, most commercial property is actually 39 years. But here you've got farm buildings with only 20 years, and you've got those single purpose agricultural and horticultural structures with only 10 years. Now, if you do have some non-farm, non-residential real property, they remind you that that is 39 years. So again, you don't have to memorize this, but it's kind of interesting to look down and see the different types of assets and what their recovery periods are. Now let's talk about farming income. How do we recognize income in a farming business? For the sale of products and assets, the sales of products of a self-employed farmer are reported on Schedule F, just like any other businesses report their sales on Schedule C. Gain on the sale of livestock born on the farm is generally the gross sales price less any expenses of the sale, such as commissions and freight. So, in other words, the basis of an animal that is born on the farm is zero, as long as the expenses of raising the animal were deducted when incurred, which is usually what happens. So you're buying feed, you are deducting it. The vet's coming out and inspecting all of the animals, you are deducting the costs of the vet, etc., and so forth. So the basis of those animals is zero. So when you sell it, you take your selling price minus your basis, which is zero, minus your expenses of the sale, such as commissions and freight. That's how you determine your gain on your sales of inventory. Now, if you bought an animal and then you resell it, then you would have a basis in that animal, the amount that you paid for it. So in that case, of course, you would deduct the basis from the sales price. Sales of non-inventory assets, such as land, tractors, livestock that are not kept in inventory, Those are reported on Form 4797 and may result in ordinary or capital gains and losses. So that's just like any other business. They're non-inventory items that you are selling. You report that on the 4797. Do note that those single purpose agricultural and horticultural structures that we saw that have the 10-year recovery period, they are actually considered 1245 property. Remember, in general, 1250 property is real property and 1245 property is personal property, but this is one of the exceptions. These buildings are considered Section 1245 property, which means, if you'll remember, they are subject to depreciation recapture when they are sold. Section 1231 property on a farm. As you'll remember, that Section 1231 property gives businesses favorable tax treatment when they sell or exchange those items. They get a capital gain and they get an ordinary loss. And outside of a farm, the general rule is that a 1231 asset is one that you held for more than 1 year, but it is a little bit different on a farm. So horses or cattle that are held for draft, breeding, dairy, or sporting purposes have to be held for 24 months or longer in order to get this special Section 1231 treatment. Other livestock, other than horses and cattle, that are held for draft, breeding, dairy, or sporting purposes have to be held for 12 months or longer. Depreciable property used in farming has to be held for longer than a year. That's just like every other business. And real estate used in farming has to be held for longer than a year, just like every other business. Unharvested crops, they are Section 1231 property, no matter how long they've been held, no matter how long they have been in the ground. So unharvested crops get Section 1231 treatment, and cut timber. So it's already been cut, but it doesn't matter how long you've had it, it gets Section 1231 treatment. Weather-related gains. If a farmer sells more livestock, including poultry, than they normally would in a year due to drought, flood, or other weather-related conditions, they may be able to postpone the gain from the additional animals until the following year. So what are we talking about here? There are times when you've got bad weather conditions and the farmers have livestock and they are normally going to hold those until later. So let's say it's summertime, there's a really bad drought, and normally the farmer would hold these animals until the following spring, for instance, in order to sell them. But the drought is so bad that they're worried that those animals are not going to make it to spring, that they're all going to die, and then the farmer's going to lose out on all of that income. So if the farmer meets these conditions we're going to talk about, and they sell those animals early so they can, in effect, cut their losses and at least get something for the animals, then they may be able to postpone the gain on the sale of those extra animals until the following year, which is when they would have sold them anyway. In order to qualify for this, they have to meet all 4 of these conditions. First of all, they have to be in the business of farming, so that shouldn't be a problem. Secondly, they do have to use the cash method of accounting. They can't use accrual method and do this. Thirdly, they have to be able to show that they would not have normally sold those additional animals if it were not for the weather-related conditions. So maybe they can just show historically that they keep the animals for a certain amount of time till they're a certain age or until a certain time of year, for example. And if they can satisfy the IRS that they really would not have sold these animals if it were not for these weather conditions. And then lastly, the area does have to be designated for federal disaster assistance. So again, that allows them to, instead of reporting that income in the year they actually sell those animals, they can wait and report it in the following tax year. Crop insurance and disaster proceeds. Crop insurance and government disaster proceeds can be received as a result of destruction or damage to crops or the inability to plant crops due to drought, flood, or other natural disaster. These payments are generally taxable in the year received. However, they too can be postponed until the following year if you meet all of the following conditions. First of all, the farmer uses the cash method again. Secondly, the proceeds are received the same year that the crops are destroyed or damaged. So if the crops are destroyed in November for a calendar year farmer and they don't receive the proceeds from the insurance or the government payments until January or February of the next year, then they cannot do this. They have to recognize those in that year that they received them. But if they receive the payments in the same year, let's say the problem happens in the spring, there's a big flood in the spring that causes them to lose their crops. And then over the summer, they collect their payments from insurance or from the government. Then they may be eligible to postpone recognizing those payments until the following year. But they do have to meet this last condition as well. And that is that under normal conditions, the farmer would have included more than 50% of the income from the crops in the year following the year of damage. So if they can show that those crops that were damaged in the spring, maybe they wouldn't have been harvested until fall and they wouldn't have been sold, most of them, until the following year. Well, if they can show, again, historically what they've done, and that more than half of those crops would not have been sold until the following year, then they can postpone recognizing the income from those insurance or disaster payments until that following year. In order to do this, a statement must be attached to the return naming the specific crops that were damaged and the amount of proceeds received. Subsidies. Agricultural program payments or subsidies and similar government payments are included in income in the year that they are received. Those payments are reported in Part 1 or Part 3 of the Schedule F. Even if the payments are later repaid, still report the full amount as income and an offsetting deduction is allowed. So maybe they receive a subsidy and then it turns out that they don't qualify for all or part of that subsidy, so they have to pay some of it back. They still include all of it in their gross income, but then they take a deduction for the amount that they had to pay back. Patronage dividends. When a farmer belongs to a cooperative, they share in the profits with the other farmers. The profit distributions are called patronage dividends, and those dividends are generally taxable. So the cooperative will report those dividends instead of being on a 1099 div, they will report them on a 1099 PATR. So that is taxable. However, dividends related to personal purchases are not taxable, but reduce the basis of the items purchased instead. So the farmer's part of the cooperative, they are probably buying things from the cooperative as well. So any dividends related to their own purchases are not going to be taxable to them, but they do have to reduce the basis of the items. So if those are items that they are going to resell, for example, then their gain on the resale is going to be greater because they had to reduce the basis. Conservation payments. Payments under the Conservation Reserve Program are taxable. There are some other cost sharing conservation payments that may be fully or partially excluded from income. You don't need to know the details of that, but you do want to remember that these specific ones, the Conservation Reserve Programs, are taxable. Rent income on a farm. Cash rents received for the use of farmland are generally rental income rather than farm income, so they are reported on Schedule E, like we talked about earlier in this video. If the rents are received not as cash, but as crop shares, then they are reported on this form 4835, Farm Rental Income and Expenses. If the farmer materially participates in operating the farm from which the rent or crop shares are received, it is self-employment income and reported on Schedule F. In other words, let's say the farmer owns a farm and they are actively working the farm, but part of it, maybe there's one field or something that they rent out to someone else. Well, if that's the case, then instead of reporting it on Schedule E, Or instead of putting it on this Form 4835, they include that as part of their gross receipts on their Schedule F. Now we will talk about some special rules for the tax computations for farmers. Specifically, what we will look at is income averaging for farmers, self-employment tax optional method, estimated tax payments for farmers, using Form 943 instead of Form 941, and then finally NOL carrybacks. Income averaging. Taxpayers in the farming and or fishing businesses may be eligible for special 3-year income averaging. This is for when current year income is high and it was low in any of the 3 previous or base years. This helps to smooth out the ups and downs. Income averaging does not change anything in the previous years. You're not going to go back and amend the previous year's tax returns. Instead, it allows the farmer to take advantage of the lower tax brackets from the previous years in the current year, thereby lowering current year taxes. So, of course, farmers can have good years and bad years. So, this is just allowing them to average this year's high income with the past 3 years' lower income. And then you can use that average as this year's income. So instead of using this year's actual income, which was kind of higher than normal, you get to use the average of the last few years of income instead, thereby lowering current year taxes. In order to do this, you report on Schedule J income averaging for farmers and fishermen, and you do not have to be in the farming business in the previous years in order to take advantage of this. And you did not have to use the same filing status in the previous years. However, you cannot use income averaging for alternative minimum tax purposes. Self-employment taxes. Self-employed farmers, sole proprietors, and partners are subject to self-employment tax just as owners of other businesses. They compute their self-employment tax just like everyone else does, but certain farmers may be able to use an optional method if either gross farm income is not more than $10,380 or net farm profits are less than $7,493. So gross income not more than $10,380 or net income less than $7,493. They can use this optional method. This allows them to report some self-employment income even though they don't actually have any or don't have very much. So what they do is, under this optional method, they use 2/3 of their gross farm income up to $6,920 as net earnings from self-employment, even if the farm operated at a loss or a very small gain. So we did talk about this concept also back in part 1, but it does apply very often to farmers. So, as we talked about back then, why would a farmer want to do this? Why would you want to report self-employment income when you don't have any? Because the alternative would be, of course, just to say, well, I had a loss for the year, so I don't owe any self-employment tax. But there are times when the farmer may want to report some self-employment income and pay the self-employment tax. First of all, in order to get credit towards Social Security. They don't have any income, they don't get any credit towards their retirement for Social Security. So that's one reason. And then secondly, it can increase their income and specifically their earned income for utilizing certain credits. Remember, back in part 1, we talked about these credits. A lot of them you had to have earned income in order to take advantage of the credit. So the child independent care credit, the earned income credit, and the additional child tax credit. So those are all reasons the farmers might want to take advantage of this. Estimated tax payments. This is very unique in the tax world, and you will want to know this. So qualified farmers do not have to pay any estimated tax and don't have to worry about any penalties for underpayment or interest for underpayment if their return is filed by March 1st and all the tax due is paid with the return. So their returns, of course, are due by April 15th, just like everybody else's. But if they can get their return done and filed and the tax paid by March 1st, then they don't have to pay any estimated payments and they don't have to worry about underpayment penalties or interest. Or even if they don't file by March 1st, if they have paid through withholding or from applying a refund from a prior year's return to the current year, an amount equal to either 100% of the prior year's tax or 2/3 of the current year's tax, then again, no underpayment penalties or interest. If neither of those apply and the farmer expects to owe $1,000 or more, they must make just one estimated payment of 100% of the prior year's tax or 2/3 of the current year's tax by January 15th of the following year. In other words, for the 2024 tax year, they would have to make this payment by January 15th of 2025. And a qualified farmer for this purpose is one for whom farming represented at least 2/3 of their gross income for either of the prior 2 years. In other words, this is not their first year being a farmer. They will be a qualified farmer. So usually remember, individuals who have income with no withholding or anything, so like business owners, have to make estimated payments in April, June, September, and then in January. Well, the government here is recognizing that farming is much more difficult to predict. Weather, disease, things like that can make it hard to know, especially early in the year, how that year is going to turn out. Is it going to be a bumper crop and they're going to make a killing? Or are the crops all going to die and they'll hardly make anything? So it's very difficult to estimate their income and therefore to estimate their tax. So what they're saying is if you file by March 1st, and you pay everything that's due, then you're good. Or if you had withholding, maybe you've got a job plus you're a farmer, or maybe you had a refund last year that you applied to this year. Well, if that amount equals 100% of last year's tax or 2/3 of the current year tax, then you're good to go, even if you don't file by March 1st. And then if those don't apply, but you expect to owe $1,000 or more, then you just have to pay by January 15th. One payment by January 15th. So you will want to know those rules for the exam. Form 943. Wages paid to agricultural employees are reported annually on the Form 943 for payroll tax purposes rather than quarterly on Form 941. So you remember most businesses have to report every quarter on the 941. For agricultural employees, you only have to report annually on the 943. Now, you do still have to pay in. So just like with the quarterly reporting, you still have to pay in either semi-weekly or monthly, depending on how much you owe. And you still have to do that even with the 943. So the payments are the same as other businesses, but it's the reporting can be done annually instead of quarterly. However, wages paid to non-agricultural employees are reported quarterly on the 941. So if you've got, for instance, a bookkeeper that you employ on the farm and you're paying them wages, they are not an agricultural employee. So their wages and withholding and everything would still be reported on a 941. NOL carrybacks. So a net operating loss from farming in 2020 or later can be carried back 2 years. Remember, most businesses, you cannot carry NOLs backward. You can only carry them forward, but there were two exceptions, and one of those was for farmers. The other was for insurance companies other than life insurance companies. But farmers can carry back their losses 2 years. In other words, they can take a loss from 2024 and they can amend their 2022 and or 2023 tax returns in order to take the loss and get a refund from those years. They don't have to carry them backwards, but they are allowed to. And then, like any other business, they can carry them forward indefinitely. When they do this, though, the normal rules apply, meaning they can only offset 80% of taxable income with their NOLs. And now let's turn our attention to our final specialized return for this video, tax-exempt organizations. Organized under Section 501c3 of the Internal Revenue Code, Tax exempt or not for profit charitable organizations do have to meet specific requirements. First of all, they may be corporations, trusts, or unincorporated associations. They may not be sole proprietorships or partnerships. They must be established for a charitable, educational, or religious purpose. You want to know those three words: charitable, educational, or religious purpose. You are very likely to get a question on the exam on that. They cannot have earnings which benefit the members of the organization or any insiders of the organization. They cannot directly or indirectly participate in a political campaign for or against a candidate for political office, and they cannot lobby for or against legislation in any significant way. In order to get this special 501c3 designation, organizations must apply on this Form 1023. However, certain organizations do not have to apply. That's churches, synagogues, mosques, and temples. They do not have to apply. Why? Because of the constitutional guarantee of separation of church and state. So they do not have to apply, and there are some other things that they do not have to do as well that other charitable organizations do have to do. Those churches and synagogues, etc., are allowed to apply if they want to, but they are not required to. Once an organization applies, the IRS will issue a determination letter either approving or denying the application. Once it is approved, the organization is tax exempt, and donations to the organization are eligible for tax deduction. So I'm sure you've all seen that. We are a 501c3 organization, and so your donations are tax deductible. So this is what they are talking about. There are other types of 501c organizations as well. There are several of them. They are usually tax exempt as well. However, donations to them generally do not qualify for tax deductions. It's only 501c3s that you get a tax deduction for. Those other organizations must apply for tax exempt status on a Form 1024. Tax-exempt organizations must file a Form 990 or one in the 990 series every year. Again, though, it is not required for the churches, synagogues, mosques, and temples or their related organizations. But all of the other charitable organizations must file a Form 990. There's also a 990EZ. This is a short form. So this is for charitable organizations with gross receipts of less than $200,000 and total assets of less than $500,000. So you will want to remember that for the exam. There's also another form, a 990N. This is an e-postcard for even smaller organizations. So for that, you have to have gross receipts of less than $50,000. And then there is a 990PF for tax exempt or taxable private foundations. So some private foundations are taxable, some are tax exempt. Either way, they have to file this 990PF. The 990 series reports the organization's receipts and expenses along with other information. It is due on the 15th day of the fifth month after year end. So that's May 15th for a calendar year organization. These are available to the public. This is much different than any other type of tax return. The IRS is not allowed to disclose tax information for other types of tax returns. IRS employees have gone to prison for doing so. Not so with a 990. If someone requests a copy of the 990 from the IRS, they will provide it to them. These are also made available by a lot of states. A lot of state Secretary of State's offices will put the 990s for all the organizations in their state on their website. The organizations themselves will make these available. So if you want a copy of their 990, sometimes you can just go to the website and get it, or you can request from the organization a copy of their 990. If an organization does not file a 990 for 3 consecutive years, then they will lose their tax exempt status. So now let's look at the 990. This is the long form. I think it's something like 12 pages long. This is just page 1 that we're going to look at. So right here at the top, it tells you open to public inspection. So in case there was any doubt, you know when you are filling out this form that it is open to public inspection. Then at the top here, you've got your normal information about the organization. You are going to describe the organization's mission and their most significant activities. There's some other information that they ask for. Then you're going to show all of your different sources of revenue and your expenses, prior year and current year, along with your total assets and liabilities. The reason this form is so long is because these amounts are just summarizing what is detailed on other schedules. So you can see here that there are other schedules from which these numbers are coming. And then it comes down to the signature block. So go ahead and look at the 990, look at all the pages just to become familiar with it so you can see the kind of information that is required. Unrelated business income. So although generally exempt from tax, exempt organizations may actually owe tax for substantial unrelated business income, or UBI. UBI is the income from a trade or business regularly conducted by an exempt organization and not substantially related to the performance by the organization of its exempt purpose or function. Use of the profits from the activity for the exempt purpose do not alone make it substantially related. So if the organization is running a business and that business is not substantially related to the charitable purpose for which that organization exists, then they have to pay tax on that income just like any other business would have to pay tax. And it's not enough to just say, well, we're using this money in order to fund our charitable purpose. That will not cut it. So let's look at a couple of examples to see how this works. Example 1. An exempt organization organized and operated for the prevention of cruelty to animals receives unrelated business income from providing pet boarding and grooming services for the general public. These activities don't contribute, importantly, to its purpose of preventing cruelty to animals, and the income is therefore taxable. So, yes, it has to do with animals. It's pet grooming and boarding, but that's not doing anything actually to help prevent cruelty to animals. The money might be going to help prevent cruelty to animals, but the boarding and grooming itself does not help to prevent cruelty to animals. Therefore, the income that is earned from running that business is taxable. Example 2. A halfway house organized to provide room, board, therapy, and counseling for persons discharged from alcoholic treatment centers also operates a furniture shop to provide full-time employment for its residents. The profits are applied to the operating costs of the halfway house. The income from this venture is not unrelated trade or business income. In other words, it is related to their charitable purpose because the furniture shop contributes importantly to the organization's purpose of aiding its residents' transition from treatment to a normal and productive life. So the people working at this shop are the ones being helped. They are learning a trade that they can use to support themselves. They are learning how to come to work every day. They're learning how to deal and interact with customers and with other employees. So, in short, it is helping the very people that the charity was organized in order to help. It is directly fulfilling the purpose of that organization. And so, therefore, that income is not taxable. If an exempt organization has $1,000 or more of unrelated business gross income, then they have to file this Form 990T and they have to pay tax on that income. The UBTI is computed by taking gross receipts and subtracting expenses. So, in order to determine whether or not you need to report and to file this 990T, you look at gross unrelated business income. If it's $1,000 or more, you have to fill out the form. But when you're actually determining the tax, you are going to subtract the expenses. So, it'll be the gross income minus the expenses that is subject to tax. And the tax rate is the same as the corporate rate, which of course is 21%. Unless the organization is a trust, in which case the trust tax rates apply. Now you are up to date on what you need to know for the EA exam with regards to rental real estate, farmers, and tax exempt organizations. That is the end of video 8. In our next and final video for part 2, we will cover retirement plans and trusts and estates. So I will see you in video 9.